Hello, Tim Knight, and I'm going to take it easy this weekend. I'm not going to go through like 8 billion charts. I'm just going to show you a nice, clean dozen index charts just to kind of catch up on that. So here we go in alphabetical order. First one is the CompQ, the Nasdaq composite. And as we zoom in, you can see that the good news took place on Wednesday, ironically enough, because the PPI came out. The market exploded higher and then just faded most of the day. We slipped more on Thursday and we slipped even more on Friday, although it fought back pretty hard. But the good news is that we have a failed bullish breakout. We are beneath this business right here. In fact, we closed beneath it. So what happened on last Thursday was horrible. And, you know, because God has mercy, that has been partly undone. In fact, we got pretty deep into that last Thursday, the CPI rally at the lows of Friday. So we're definitely fighting back. The bulls are definitely not in the driver's seat like they think they are. Here's the Indu. The fact we're above this can't be undone. We have gotten above the trend line. We're also kind of stuck there. So for 7 days in a row, it just has been drifting there. 1, 2, 3, 4, 5, 6, 7. The asterisk to that is that we have not gone above the most recent lower high. So the lower highs are still intact as long as we stay beneath this fella right here. It would be nicer if we didn't go above the trend line, but what can you do? The Nasdaq 100 NDX. We've got this enormous top still in place. We're range bound right now, as you can see. The top of the range is this dashed line. The bottom of the range is this Fibonacci. We need to break this, which would also break this, by the way, which goes way back to 2009 in order for the next leg of the bear market to start. So this zone right here is the key. And we're way above that right now. So anyway, yeah, still range bound, and that's the... You know, we could bang between here for the rest of the year, as far as I know. Could, you know, it's a pretty wide range. S&P 100, still beneath this rather sloppy top. You know, what's been grueling about this has been this and this and this. Because, and you know, I guess this is typical of bear markets because this is back in the internet bursting bubble, and in this instance, you know, we had these big counter-trend rallies. You know, we had one here and here and here, which in retrospect we can see was the bottom. But these are violent, nasty rallies that take place. But from this great distance, you can see that the notion that we're at some kind of like cheap bargain price is laughable. So in spite of all the damage already done. The Russell 2000, quite a sloppy chart. Wide range between these two Fibonacci's. Still respecting the descending trend line, but same old, big range. We could just bang between that for the rest of the year. The semiconductor index is somewhat cleaner. I like the semiconductors. I like AMD, NVIDIA, that sort of thing. This violation, you know, is a pretty big wart in the whole thing. But again, take a step back and you can see at this distance, it's a pretty impressive top. In fact, on this whole history, it's probably the largest, cleanest top for this entire data set. Importantly, here's the S&P 500, which goes back to the 1900s, believe it or not. And as we zoom in, I've all the lines you see here are Fibonacci retracements with this exception, and I've made it look different to highlight that. This is the delineation between the top and what lies beneath. We, of course, famously bottomed on October 13 here at this major Fibonacci. We clung to this pair for a while, but we've escaped above that. What it's going to take to finish this bear market, I believe, is a trip to this trend line way down here. So something like 3,200 and change. That would smell like a good bottom to me. Boy, that came out wrong. Anyway, you get what I mean. Dow Transport's pretty cool. Pretty nice series of lower lows and lower highs. In fact, while I have your attention, I'm just going to, I don't know if it'll look good at all. I'm just going to try to see what that looks like. Now it looks pretty wretched. Yeah. I've seen worse, but sorry to waste your time like this. I'm trying to just tease out some kind of line here. Well, like I say, I've seen worse. We'll leave that there as kind of a channel. Yeah. In fact, what we'll do is anchor it there and we'll unextend it. And okay, so anyway, there's the transports. You can kind of see the wave going on along the way. Here's the Dow Utilities. Probably one of the less interesting charts out there, but I've done my best to anchor a line there. But as you can see, it's a big fat mess. It's not great. That probably will get nuked next week, but it's not an important index to what I'm doing. Very different creature here, the VIX, of course. This tremendous prospective basing pattern still in the works. You know, this is gonna be a multi-year project, but we're getting there, and its volatility is pretty cheap right now. The major market index, this stalled out way up here and has been engaged in these violent moves up and down. The ups tend to be more violent than the downs. But as you can see here, we've got a goodly amount of overhead supply, which has put the brakes on this ascension nonsense. Last one, favorite for good reasons, the oil index, the energy index, like so. Lifetime highs this week and a failed bullish breakout. So that could be a good sea change. All right, that is the dirty dozen.